and then I will kick it off. Well, welcome everyone. Thank you for joining us for our I guess webinar series. Today we're going to be talking about Washington policy updates and planning consideration for 2024 and beyond. I'm Jeff Smith with Owl Private Wealth Advisors. On behalf of Brian Thomas, Chris Hamilton, and Stacy Bigley, we'd like to welcome you and thank you for joining us. Today our guest speaker is Bill Cass. Bill's the Director of Wealth Planning for Franklin Templeton. He speaks regularly throughout the country to groups of financial advisors and investors on a wide range of financial planning topics, focusing on areas such as effective retirement income strategies, tax legislation developments, personal risk management, and efficient wealth transfer. I'm a huge fan of his work. You've probably seen me plagiarize or share it many times, as well as repost to LinkedIn. So I will hand it over to Bill and let him take it away. If you have any questions, there's a Q&A chat box. You can always throw it in there or raise your hand and I can perhaps let you talk and then you can ask those questions. If you can't think of any now and you'd like to ask them after the fact, we can always find out from Bill what he thinks or have his commentary. So I will mute myself and Bill, I'll let you take it away.
Great. And I'm going to share my screen here. And Jeff, give me someone give me a thumbs up.
Good.
Perfect.
Looks good.
Perfect. All right. I'm excited to be here getting us today, this afternoon. There we go. I think we're good to go.
Yep.
I'm happy to be here. As Jeff said, my name is Bill Cass, Director of Wealth Planning at Franklin Templeton. And what me and my team does at Franklin Templeton is we focus all of our time and efforts on, as Jeff alluded to, is financial planning, taxes, estate planning, retirement, even college savings. And given that it's election season, we're spending a lot of time on the election as well, because as we know, elections may drive changes, regulatory changes, legislative changes. And one of the big themes we're going to talk about today is not just the election and what's been going on in Washington, but also is looking ahead on the tax frontier, given the fact that the tax code as we know it today, for individuals anyways, it basically expires at the end of next year. So there's a lot of uncertainty, and we'll just share some thoughts. We don't have a crystal ball. I didn't bring that with me today. I left it at home, but we'll share our best thoughts on some potential scenarios, and most importantly, some conversations you want to have with Jeff and the rest of the team on your personal situation if you are concerned about higher taxes in the future. So like I said, today we're going to talk a little bit on the election outlook. I do want to talk a little bit about the retirement side, because over the past couple of years, we've had some changes on the retirement side, and I have been getting quite a few questions, and I just wanted to cover a couple quick areas just to make sure folks were clear about that. And then we're going to really wrap it up on talking about what's going on in Washington from a spending perspective and a debt perspective, and how that might impact the world post-election as we turn our eyes to the income tax side and also the federal estate tax side, and what we might be seeing going forward, depending on potential outcomes of what's going to happen as we come out of November. And most importantly, we want to highlight financial planning opportunities. What are some things you want to be thinking about on the retirement side, the tax side, both on the income tax side and maybe on the estate tax side as well. So I always like to start off with this picture here, the current makeup of Congress. And you see that the House and the Senate, obviously very, very thin margins for both, right? And I think that coming out of the election, I think regardless of who wins, we're still going to be with very, very thin margins. Those colors may change around a little bit, but the numbers are probably going to be pretty close to the same, in that ballpark anyways, okay? Because I don't think we don't see a scenario where one political party is going to have a 10-seat margin in the Senate. right? It's going to be very, very thin. And the same is going to be true for the House of Representatives. I don't think we're going to come out of this election with somebody holding a 40 or 50 seat margin in the House. Just not going to happen. And so everyone's really concerned about, okay, who's going to control the House and who's going to control the Senate and how does that affect me and what does that mean for taxes? But you always also have to remember that if whatever party is in control, if they want to get something done, they need control, obviously, right? But they need some margin of error, and that's what we've seen. We had a major tax bill pass the House a couple of years ago, right? And it got to the Senate, controlled by the Republicans, and it just died there. So I wouldn't make assumptions that just because one political party has control, you still need that margin because you have wild cards both in the House and both in the Senate that might deviate from the standard party line, certainly. As we talk about the Senate, this is some information from the Cook Political Report. And basically, what we're showing here is that the Democrats are facing a real uphill battle for maintaining control of the Senate. And it's not just the number of seats they're defending in the cycle. Obviously, they're defending more than twice as many seats as the Republicans are defending, but it's where those seats are. So, for example, West Virginia, Joe Manchin is not running for re-election, right? That the Republicans will take that seat. I don't know. You have to say 99%. I guess you can say 1% chance of some type of weird thing happening. But for all intents and purposes, the Republicans are going to pick up the West Virginia seat. And that brings us to a 50-50 sort of split in the Senate right now. And then if I'm a Republican strategist, then we look at, okay, can we take Arizona? Can we take Montana? Can we take Ohio? Some of these others. What about Nevada is another one, right? So can they pick up one of those seats? And that's not certainly a given. In the election, so Trump versus Biden, Trump's going to win Montana by a pretty wide margin, right? That might be a 15 to 20 point margin. Now, that's an uphill battle for Jon Tester to maintain his seat. But Jon Tester is he's got a lot of support still in Montana. So, that just doesn't mean automatically Jon Tester is going to lose to his Republican challenger for that Senate seat. So, I wouldn't say that it's definitely, if you're a Republican strategist, you feel good about the Senate map. But I don't think it's like an 80% chance that the Republicans get to 51 seats, right? Assuming we're already at 50-50 with the Manchin seat. But it's probably a 65% chance right now. And a lot can change between now and the election. And then on the House, the Democrats feel there's reasons for Democrats to feel optimistic about the chances in the House and taking back the House. And one of the reasons is you have almost 20 Republican folks in Congress, in the House, that are in districts where Biden won in 2020. And remember, these folks won in 2022, right, in the midterm elections. So there wasn't anyone at the top of that ticket in 2022. There will be in 2024. Whereas the House, there's a much bigger impact of the coattail effect. Okay, who is someone voting at the top of the ticket, and does that carry all the way down, down to other areas of that ticket, lower levels of that ticket? We don't see that coattail effect as much in the Senate, certainly. That's more of a House phenomenon, much less in the Senate, which tend to be more nationalized type of races. They get that type of exposure. But all things being considered, if I'm a Democrat strategist, I feel pretty good about the House. Maybe not as good as a Republican strategist feels about the Senate on that side. I wouldn't equate those two. But I think overall there's reasons for optimism, for the Democrats and their chances to take back the House. Obviously, a lot will be driven by the race for the White House. So the key battleground states in 2024, and this is just taking results from 2020, the 2020 election, and the 10 closest races. And the thing we're focusing on is a lot around the top 7, right? The usual suspects: Georgia, Arizona, Wisconsin, PA, North Carolina, all the way down to Michigan. And I was joking with Jeff beforehand And this cycle has in my lifetime, and I was born in 1966. This might be probably the most politically charged election in my lifetime. 2016 was, there was a lot of noise in the 2016 election, but this election is a good chance to surpass that, right? I haven't seen a lot of the noise, but then again, I'm in Massachusetts. And we're not seeing ads in Massachusetts. We're not in battleground state Massachusetts. So folks in these states on this list are seeing a lot of that messaging. And unfortunately for those of you that might be sick of all that, that's going to continue to amplify as we approach the first week of November. Now, where do we stand now? If you look at the polling averages in the battleground states, Trump is winning in all states. In Michigan, Wisconsin, Pennsylvania, it's very, very narrow. It's within a percentage point. But in Georgia, Arizona, North Carolina, Nevada, it's more like, and these are averages, right? Polling averages, 4 to 6 points. So that's where we stand today. But as I travel around the country, I'm really careful to let people know that just think about baseball. We're in the very early innings of a 9-inning baseball game, or I don't know, Jeff. Maybe I should say 9 innings. Maybe this goes to extra innings. I don't know. We'll have to wait and see. So we're in the early innings, and and I even joke there could be a rain delay or two in there as well. So, this Trump people feel good about the polling, right? And we know polling is not scientifically perfect, but it was if you look at the polling in the midterm elections, the polling was actually pretty accurate in the midterm elections. But again, if the Biden folks, a lot can change between now and then. And what to watch for, we'll see how the Trump legal cases pan out. The jury, I guess, is going to get instructions on the New York case next week. And will that have an impact on polling? Who knows? Some of the Washington experts that we talk to and we rely on a lot, I mean, they're more focused on the January 6th case. That's really where their focus is. And will that case happen? Will that actually, happen before the election or not? It's looking less likely so now. Just that, where we are, we're almost in June, right? But that's the one that at least the folks that we talk to say that would have potentially more, impact on moving the dial in terms of the polls. One of the other good indicators is what does the S&P do? The S&P 500 do? What's that 3-month performance leading up to election? That's a pretty good indicator if it's up that the incumbent party maintains control. There's something also called the misery index. So the misery index is a combination of leading up to the election, where are we at with inflation and then unemployment? And if that's above a certain level added together, then that's another indicator. But there's always exceptions to the rule, right? That we're watching. So again, long way to go. But I think regardless of who wins the White House, I think you're still going to have very slim margins in the Senate. And it's not going to be a 100% referendum on that. If that party even controls, Democrats or Republicans, if they control the White House, the Senate, and the House, they're not going to have enough margins to go forward on their whole list of policy objectives, right? I just don't see that happening. So I think when you hear a lot of noise and a lot of hyperbole, I think you just want to take it with a grain of salt and just sort of, maintain some perspective. So we're going to come back to taxes. We're going to come back to the elections in a couple of minutes. But I wanted to take a pause there because there's a lot of things that have happened on the retirement side, a lot of positive developments on the retirement side. Most recently, the Secure 2.0 bill. I'm not going to go through that in chapter and verse. And we do have a one-page sort of high-level overview of the bill and how it impacts regular investors or savers like yourself. And we can certainly, Jeff, you probably have already seen that, but we can get that to you certainly.
I can circulate it afterwards, certainly. So.
Yeah, that'd be great. There's a couple I wanted to point out, and I think this is all really positive stuff. Oh, by the way, I'll add another one. If you are a small business owner, or you know friends or family members with small business owners, and they do not sponsor a retirement plan, they don't have a SEP IRA, they don't have a simple IRA, they don't have a 401k. This is the time to look at that, because the government through this retirement legislation is basically saying, hey, we want small business owners to establish retirement plans. We want more people saving in a workplace savings plan, a workplace retirement plan. So what we're going to do is provide very, very rich tax credits to incent business owners to start plans. So if that fits your profile or someone you know, you want to take a look at this, because I won't get in all of the numbers, but in a lot of cases, basically what the government's saying is, hey, we're going to pick the first 3 years of your plan costs in terms of startup, administration fees, all that type of stuff, to incent you to start a plan. Because folks like me, I've been in a 401k plan my whole career. I've been working for big firms like Franklin Templeton now, and before that, before we were acquired, I worked for Putnam Investments for 30 years. I've always had access to a 401k plan, but on the small, folks that are employed by small business owners, it's just not the case, and we got to increase that. So I just want to mention that. But there's two other areas. I'm going to talk about required minimum distributions. I'm going to talk about 529s and Roths for a minute too. On the required minimum distribution side, we all know the story here, right? When you get to be a certain age, the government's going to force you to take money out of your IRA or your 401k. There's some exceptions, but when you get to that age, now you have to start taking the money out, unless it's a Roth IRA, right? When a Roth account, if you're the owner of a Roth account, then you don't have to. There's no such thing as a required minimum distribution fee, which is good news. But a traditional IRA or 401k, you have to take the money out. And what the government has done is said, maybe it's because they're realizing people are living longer, but they're sort of giving us a break and saying, okay, we push that age out. Okay. For many, many years, my whole career was 70 and a half. And then it was changed to 72. And then subsequently, they changed it to 73 and maybe even 75. So, for example, if you were born in the 60s or later, like myself, your required minimum distribution age is 75. So just to be aware of that. But I want to make a point on this, because what we see happen a lot is people sort of being on autopilot, and they don't take any money out of their retirement account, their IRA, until they're forced to. And I think for some people that doesn't make sense, because I think for some people they might be in a modest tax bracket and they haven't reached the required minimum distribution age. They might want to take some money out of that RMD, out of that IRA, for example, before they're forced to. And if you wait till you're forced to, then you have a larger RMD, even if you don't need the funds. And if it's in a traditional account, obviously you're going to pay taxes on it. You're going to have to report that as income. So I would encourage you to reach out to your team, to Jeff and the rest of the team, and say, hey, based on our situation, should we think about taking money out? Or even remember, if you get to be 70 and a half, you can donate it directly out of your IRA to a qualified charity. It's called qualified charitable distribution. That's a great option for folks that might not rely on the distributions from their IRA to meet their day-to-day needs, and also want to give philanthropically at the same time. So just a point on the increase in the RMD age. Just don't automatically wait until you have to take it out. Maybe consider taking it out early. Obviously, you don't want to pay a penalty, so you want to wait till at least 59 and a half. But you want to be as tax smart as possible. And then this is one I've been getting a lot of questions on. Okay, so this is brand new, and it begins this year. And Congress put this into this retirement bill. And what they're saying is that, hey, if you have leftover money, basically in a 529 college savings account, college savings plan, then we're going to give you another option. If you want, you can take that money or a portion of those funds and transfer directly to a Roth IRA. And you see the rules here. There's some limits. You can do up to 35,000 over a lifetime. You can't do 35,000 every year, but over a lifetime. And for example, here's how it would work. And it basically is the same as a contribution into the Roth IRA. Okay. And this is what I mean by that. My oldest just graduated about a year ago from college. And if we had money left over in a 529, what we could have done, and we went through it all, but we could have taken this year 7,000 out of the 529 and moved it into my daughter's Roth IRA. So it's like a regular $7,000 Roth IRA contribution. So for example, if you want to do 35, you can't do it at once, but you do 7,000 each year, right? So it's seen as a contribution. One of the questions I got earlier today was, hey, if I move the money from the 529 to the Roth, let's say I move 7,000, can I also do a separate Roth IRA contribution or even an IRA contribution? The answer to that is no. It counts towards your contribution. But what it doesn't take into account is it doesn't matter, anyone can move the 529 money to the Roth IRA. It doesn't matter how much income you report. So you might be aware of this. With a Roth IRA, if I want to contribute to a Roth IRA, if I make too much in income, I can't do that directly. So with this provision, it doesn't consider that. Okay. So, I think this is really good news and I think that Congress's intent, this is my opinion, they were trying to say is we need parents, we need families to save for college education. The earlier, the better, right? Let's get started as early as possible using a 529. Okay. We don't want them to have some maybe objections or some concerns and saying, okay, what if, I do all this saving in a 529, we get to that point and my, my son is recruited by U of M to play defensive tackle. It's going to get a full ride to be a Wolverine and play in the football team. And by the way, I was born in Michigan, Jeff, although I grew up in New Hampshire. I'm a big U of M fan, by the way. So
I won't hold that against you. We all can't be rodents. Don't worry about that.
I know there might be some Sparties out there, but I have to be true to the
That's okay.
to the maize and blue. So so I think this is the way the Congress is saying, hey, if that does happen, then you got another option. You got another option. Obviously, you can always change the beneficiary on a 529. Here's another question I get is, what if I have a situation where me as a parent, I'm the owner, and we have leftover 529 money. And from my standpoint, I'm like, okay, this is great to have this option. But at the end of the day, we paid for college and the kids are good. What about me putting this in my own Roth IRA, right? How about something for me as the parent, change the beneficiary from my daughter to myself and then do the transfer? The short answer is yes, you can do that. You can do that. What we don't know for sure is there's a rule with this provision that says the 529 has to be established for at least 15 years. What we don't know is if I change the beneficiary, does that reset that 15-year clock? I don't think that was the legislative intent. I don't think changing the beneficiary should change the date of establishment on a 529. You can change the beneficiary, all the time if you want. This is not a taxable event or anything like that. But I just want to say that we're hoping that the IRS provides some guidance there in terms of the legislative intent. So that's one thing that we're sort of waiting on, and hopefully we'll hear some clarification from the IRS on that. All right, so what I want to do now is transition to sort of wrapping up our conversation today. We're sort of kind of going to come back to the tax world. I'll mention the election. We'll talk about some scenarios and some potential outcomes and what you can be thinking about with your own personal finances if you're concerned about higher taxes in the future. And by the way, this is my opinion. I don't know if the tax rates, the tax brackets, et cetera, when they expire at the end of 2025, one of the scenarios is that, hey, they get extended. They get extended for another scenario would be they're just made permanent. I don't think that's going to happen. I think that's cost prohibitive. But the one scenario is that, hey, we just, they push through a bill through Congress and we extend this thing for 5 years. That might happen. I wouldn't say that's my base case. But even if that does happen, I just think down the road, we have to be thinking 5 years, 10 years, 15 years. I just think we're going to be in a it might be gradual, but in an increasing tax environment, some way, somehow. It might not just be with the rates. Jeff, you have a question?
No, I was just checking to see if it would show up for when people
Okay,
want to do
it
it. So
did.
sorry to interrupt.
I saw your hand raised. So I give that as backdrop, and obviously the level of federal debt is has been a challenge historically. If you go back to 2010 or so, coming out of the Great Recession, but it's obviously it's just accelerating, and it's on an unsustainable path. So let's take a look at some of the tax rates and brackets, okay? And this is a piece that I put together, and then Jeff has access to this piece, but I just took a part of it and put it on the slide. So what we're looking at here is the 2024 tax rates at various income levels, and then I have projected tax rates. That's what it would look like at income levels and with brackets and rates if the tax code expires as it's scheduled. Remember, if Congress does nothing, we basically go back to 2017 and those tax rates and those tax brackets, okay? Adjusted for inflation, but it would be a net tax increase for more taxpayers. And if you look at the column all the way on the right with the difference, I mean, a few things jump out. I mean, if you just look at the comparison, this is joint couples, by the way, making 289 to 383. Within that slice of income, they go from paying 24 cents on the dollar on a marginal tax rate to 33 cents, the 9% difference. Look at even the second lowest bracket goes from 12 to 15%. So, this is what happens if Congress does nothing. And we're going to have to wait to see how this plays out. And they might, this thing might get extended fully for 5 years, or, I think it's more likely we see something in the middle, that maybe on the lower brackets, we've sort of maintained the same, but at higher brackets, they're going to, those tax rates will go up. That's sort of my base case. And it's not just the rates, it's also tax provisions, right? And I just took some examples, right? The standard deduction gets cut in half. The SALT deduction, that when you deduct state and local taxes, that actually would get better. The $10,000 cap would go away. But for example, alternative minimum tax comes back in full force. So I won't bore you with the details of alternative minimum tax, but I will share a stat. Right now, this year, about 200,000 people in the US will pay alternative minimum tax, right? If the tax code expires as scheduled at the end of 2025, we go back to around 6 million taxpayers paying AMT. So, that's a negative. And then we have the estate and gift tax. Right now, you can shelter over $13 million from during your life or at death from federal gift and estate tax. That basically gets cut in half at the end of 2025. Now, for some people, that doesn't matter, right? I mean, at certain wealth levels, it doesn't matter if the number is 13 million or 7 million. People are going to be underneath that, and they're not going to have to worry about the federal gift and estate tax. But there's going to be certainly higher net worth, families or taxpayers, ultra high net worth families. Someone sold a business, they made a lot of money. They're certainly following this very, very closely. So let me share some thoughts on the outlook, what we may or may not see. And again, this is, this is a high level of uncertainty here, to say the least. So if we just look at a Republican sweep, what they're going to say, what the Republicans are say, if they can take the White House, they hold on to the House and they take the Senate, right? One of their biggest policy items is going to be say, hey, we're going to extend the Tax Cuts and Jobs Act. We're going to extend these tax rates, these tax brackets. Again, I don't make it impermanent. I think the cost is going to be too high, but maybe they look out 5 years, and that's still going to be a multi-trillion-dollar cost. So if you were and this is again my opinion, if you're of the mindset that, hey, if the Republicans take everything, then it's a no-brainer. This thing's just going to get extended. I would not. That is not an absolute certainty at any level, because of the cost of doing that. You still have to play within the budget rules. And I know the Capitol Hill math is fuzzy, but there's still rules you have to follow. So I'm not saying that if you see a GOP sweep, then this is definitely going to happen, by no stretch. So I think there still isn't, you know, I think it would be, you still have a strong case that maybe it gets partially extended, and people at certain tax brackets are going to see a higher rate. They're going to see more higher, bigger tax bill, right? The Democrat sweep, you know, I think they're gonna have a whole list of items, tax related items, tax increases on their list. I think they would pursue raising the corporate tax from 21% to maybe 25. Probably 28% may be a stretch, but maybe to 25%. They're going to look at really targeting wealthy families. You know, even if the Democrats sweep this, there's going to be such a thin margin in the Senate and the House, which means that a lot of these tax increases, I think, would be, you know, certain tax increases would be difficult to push through. I don't think the Democrats or the Republicans would let the Tax Cuts and Jobs rate expire, because one of the reasons is, what lawmaker wants folks in the second lowest tax bracket to get a tax increase? That's, I don't care if you're a Republican, a Democrat, a Libertarian. I don't think that goes over well. So I think there's going to be some impetus for at least, you know, looking at that at the lower brackets. Now, the higher brackets, yeah, I mean, I think there's a pretty good chance we go back to higher brackets as your income, or a higher tax rate as your income increases. And in divided government, I think we see something in the middle. I think we see a partial extension for some taxpayers. Higher income people are going to pay more. Maybe the Republicans, you know, they negotiate and we keep the estate tax where it is, you know, and they, you know, it's like both sides are going to get a little bit of what they want, and neither side's going to be happy, totally happy. So that's sort of where I'm falling, is that if you had to ask me, and I'm not saying this with great certainty, but I would say we'd get a mixed bag, that we wouldn't just see, even if the Republicans win, we just wouldn't roll it over for the next 5 years. I think there's going to be some impediments to that. And maybe I'm going to be wrong. I've been wrong before. And I'm not saying I'm 80% sure of that. I might not even be 50% sure, but that would be my, if I had to think about all the scenarios, that's probably the one that I would opt for in terms of the biggest probability. And then lastly, you know, when we talk about tax increases, everybody's focused on the tax rate went from, you know, A to B or whatever, but there's a lot of different ways the federal government can tax you, right? It's not just about the rates. You know, it could be Medicare, you higher Medicare Part B and D premiums, you know, things like that. Limitations on using certain trusts, that more advanced trust planning techniques, that there's a lot of scrutiny around. Certain things like grantor trusts, and we won't bore you with the details of grantor trusts or family limited partnerships today, but they have a lot of different levers that they can play. So as as an individual saver, I think one of the things to think about when it comes to income taxes, and if you're worried about higher taxes in the future and what can you do, I think you want to think about tax diversification. That's really where I would go. What can you do to make sure you have some diversification tax-wise across your assets? Meaning, you own some taxable accounts. Taxable accounts aren't the worst thing in the world. You know, if you have equities, because you're benefiting from a lower dividend rate, you're benefiting from a lower capital gain rate than ordinary income, right? And then you obviously have your bucket, which is a big bucket for most people on the traditional retirement side, your IRA, your 401k. I love tax deferral, but remember, those funds have to come out at some point, and they're going to be taxed as ordinary income, okay, at the highest marginal rate you're at. And then what do you have on the tax-free side? Maybe health savings accounts or Roth. And if you can have some diversification, I think when you get into retirement, that just gives you more flexibility on, you know, for example, if I'm in a lower tax bracket in retirement for one particular year, maybe I take even more than the minimum out of my retirement account, my traditional retirement account, you know, up to a certain point, because I look at it and say, hey, that's a pretty good deal. I'm in a lower tax bracket. Conversely, if I'm in a higher tax bracket 1 year in retirement, if I have at least some savings in a Roth, then I can tap into that. It's tax-free, you know, assuming you followed all the Roth, the rules for meeting a qualified distribution, right? So that diversification allows you, you know, more. And what we're not talking about, and there's a lot of focus on Roth conversions, we're not talking about doing being super aggressive with Roth conversions if you're in the highest tax bracket, just giving the federal government a lot of tax money today. You know, what can we do? Or what tax bracket are we in? Can we do a little bit, a smaller Roth conversion? Or can we do what's called a backdoor Roth contribution? Jeff and his team can tell you all about that. Maybe there's opportunities to save in Roth accounts within your retirement plan at work. And so there might be some options to, you know, if you have that source of at least some tax-free income in retirement, if you need it, that's going to give you more options, right? Than just being at the mercy of, all I have is this big 401k or this IRA. And if I need more money, I take it out and then I just keep, you know, giving the share to the federal government, right? So that's my main message from today. And then there's a whole host of other considerations based on your individual circumstances, you know, reviewing retirement plans. And you know, for higher net worth folks, depending on their wealth level, they might want to consider gifting more, getting money out of their estate now before you have a potential of the estate tax rules changing. You got to be careful about that, because if I could gift aggressively, get money out of my estate, put it in an irrevocable trust, but then maybe the numbers don't change. Maybe Congress, they come to some deal and the number isn't cut in half and the estate tax doesn't change. And now I'm sitting with money in a trust and maybe I didn't need to do that. I don't have control over it. And there's a thing called step up in cost basis. You know, if money in an irrevocable trust, you know, once I pass away, is not going to get, the cost basis is not going to get stepped up at my death. And, you know, that's a whole different discussion that we could have. But just keep that in mind, step up in cost basis. That's important. So I'm going to leave it there, Jeff, to see if you have any questions or any areas you want me to touch base on a little bit deeper, or anyone out there if you want to ask some questions.
Well, if anyone has any questions, if you hit the raise hand button, I can then turn your mic on and let you speak. And if we don't have any, I have a couple that I can throw out there.
Sure.
Well, since no one's raised their hand yet, let me ask. So you mentioned towards the bottom, factor potential changes to Social Security. Many of the people that are on the conference right now are collecting or are close to collecting. What are your thoughts in terms of, I know there's the Boston University Social Security Fix-It book, but no normal person wants to read that unless they do this for a living. But what are your thoughts on ways that they can look to sort of solve the problem? Because we understand that the men and women of Congress, their only job is to get reelected, not solve problems. And many of them want to just get reelected, not solve any problems. So they're not going to do anything until they absolutely have to, and then they'll blame everyone else that it wasn't their fault. So what are your thoughts on ways or strategies that they can take to shore up the Social Security Trust?
I think that, so at some point, there's going to be action, just like we saw in 1983. They had a similar situation in 1983. Did they address that? You know, in 1978, no. They sort of waited. They waited, you know, to the, like, watching a lot of playoff basketball these days. You know, the shot clock was almost going off, right? Unfortunately, that's probably going to be a similar thing, that it's going to be 2032 or something, and this stuff is going to, this is going to accelerate, right? There's going to be some type of bipartisan congressional commission, et cetera, et cetera. There's two things that they can do. If you look at the categories, they can raise taxes related to Social Security, and there's different ways to do that, and they could reduce benefits. The bottom line, in my opinion, whatever they do is going to be a combination of both. The older you are now, the less impacted you would be. If you're getting Social Security now, and again, when this stuff happens, there's going to be a lot of noise, there's going to be a lot of misinformation, but you're largely, especially if you're not working, you're not going to be as impacted. One thing you could see is that your cost of living adjustment every year, they might change the formula on it where you get a little less. Not a huge deal, but you start extrapolating that off of 60 million recipients, and then it starts to add up to some real money. For people that are working, this is what I think is going to happen, especially higher income. they're going to be paying right now. You pay payroll tax 6.2% up to, let's call it 160 or 170,000 of your earnings of your wages, right? That number's got to go up. There's different ways they can do that, but that number is going to go up, and that's going to be a tax increase. The other thing that I think would happen is I think there'll be phased in an increase in the retirement age. I was born in the 60s. My retirement age is 67. If you're born in the 2010s, your retirement age is 67. Heck, if you're born this year, your retirement age is 67. So I don't think they're going to raise my retirement age from 67, but folks may be in their 20s or 30s. Maybe it's, for some, it's going to be 67 in 6 months, then 7 months, then 8 months. It's going to be some type of gradual thing. So I think as you're closer you are to retirement age, I think the impact is less. If I'm talking to someone, Jeff, who's maybe, 45 or younger or 50 or young, one thing you want to think about is that I might, whatever, if I do a retirement income projection, how much I need to live off of retirement, and I'm factoring in Social Security, maybe I really be super conservative. Maybe don't factor in it at all, or maybe I factor it in if my calculator says I'm going to get $1 Social Security, maybe say 75 cents. And then what do I have to do to sort of make up that difference? And if I have 10 years to do that, then I think it's a doable thing. I make some adjustments here. I'm not saying it's without pain, but I think that's the way to approach it. So a long sort of winding answer to your short question, Jeff. I'm sorry.
That's okay. You mentioned, diversifying tax liabilities and being able to do Roth conversions and having buckets of money to take money from. We're big fans of using HSAs for saving and not using them if you can, and then having a bunch of money and saving all your receipts for a look back for one source. The other thing that we like to do is bracket stuffing. And this can be a point of contention with CPAs. They're wonderful people that are great history teachers that, want to save people on taxes year over year, but we can run into some speed bumps because why would you want to do this now? And our thoughts are like yours is, what's going to happen in a few years or 5 years or 10 years when those assets potentially double again? Is that something that you see happening a lot where people are saying, all right, we're not going to move up into a higher Medicare IRMA bracket, but we could do a Roth conversion this year at historically low rates and do 20, 30, 40, 50, $60,000 of conversions. Are you seeing that a lot more because it's being amplified because this line in the sand that might happen? And again, if we don't know if it's going to get extended, but it doesn't seem like a bad idea in the current environment because we have to use the laws that are in front of us. And that seems to be something that we're doing more and more.
Yeah, for people that are professionally advised, like your clients, we're seeing it more. Now, are we seeing it enough? Even from people who are professionally advised? No. I would not say, and I travel the country and I meet with a lot of firms, a lot of financial advisors, a lot of teams, right? I'm speaking at conferences, I'm in your offices, and I would still say that the advisors and the firms, the teams that sort of do a good job of that, of filling up those buckets with Roth conversions is the exception than the norm.
Okay.
But I'm seeing it definitely. 10 years ago, no one was talking about that. And then,
20 years ago, no one even did tax
steam.
loss harvesting. They all just said, hang on to it or buy more. No one looked at it from a tax perspective.
No, and I'm a huge fan of that. I have a friend of mine who typically is in a very high tax bracket. And he is, one of these things where his company got bought out and so on and so forth. He's sort of looking for a job, and he's got assets to live on, but his income for this year is going to be a lot lower than it has before. This is a perfect opportunity for him. He's got, a rollover IRA from his old job. I was telling him the other day, I was like, at least fill up some of those lower brackets because, when you get your next job, you're not going to be in these tax brackets anymore. Or maybe someone who retires early, at 60 or 59, and they're going to consult. And they're going to make some money, but maybe for 18 months, they're sort of just taking a back seat. Perfect time to do a Roth conversion.
Yeah.
And sort of, take advantage of that of that tax bracket situation. So I couldn't agree with you more.
The third item on the bottom, planning for a 10-year rule, and we know that the government does wonderful things when they pass laws because they're not experts in tax and sometimes have consequences that they didn't think. So if we have a client that it passed away or loved one passed away, they inherited, under the law, it was over 10 years and they really haven't given any clarification. Is it annually? Is it by the end? Have you heard or seen anything where they've kind of updated that?
So here's where we stand with that, and I'll just take a step back. So if you pass away and leave your IRA to someone other than your spouse, like the kids, for example, okay, and we'll just use that because that's usually what happens, if the spouse isn't living, then the kids, and there's limited exceptions, right? Chronically ill, that type of, but very limited. The kids basically have to withdraw all the funds out of that IRA within 10 years. So because they have that less, and before they, based on their age, they might have had 40 years to do that based on the old rules. Now they got 10. So they got to take out more sooner, and that's going to potentially impact their tax bill. So we know they have to take it out within 10 years following the year of the death of the account owner, right? What we don't know is, can they just, take it out at the end or just pick and choose? We don't know the answer to that. So what the federal government came out and said a couple of years ago, it says, if the account owner, the owner of the IRA passes away and they hadn't started taking money out, maybe they were 65, they weren't required to take money out, then the money would go to, for example, the son or daughter, and they have 10 years to take it out. They don't have to take it out any amount any 1 year. They just, by the end of the 10th year, just got to make sure that account balance is zero. They can do whatever they want, but it's at the end of the 10th year, it's all got to be out. IRS also said, they came out and said, well, if the person is older, meaning they'd already started required minimum distributions, they were 80, 85, whatever, over than the RMD age, then the son or daughter has 10 years to take it out, but they also have to take, at the minimum, an annual distribution for the first 9 years based on their life expectancy. These are proposed regulations. They have not been finalized. The Treasury Department came out recently and said, okay, we are looking to finalize these by the end of the year, 2024. In the meantime, if you have any questions about whether you have to take something annually in addition to the 10-year rule, we're going to give you a break on that, basically. So they're giving you some leniency there while they sort of wait to finalize this rule. That's where we stand right now.
So no RMD penalties. It's just you're going to have to make it up. They're going to get it eventually anyway, so they're okay.
And Jeff, I've been telling people now, just because they're giving you a break, they're not giving you more than 10 years. You're still subject to the original 10-year period.
Yeah.
So even though we don't know what's going to happen, people should be looking at that 10-year period and say, okay, what's my tax bracket today? Should I take some out today?
Yeah.
It's going to depend on a lot of different factors.
Yeah, we've been trying to stuff brackets, at least take what we think the minimum would be, or again, if they're in between or work is optional and they haven't started Social Security yet, rather than use their IRA, fund their lifestyle with the Benny IRA and kind of go from there. Do you imagine that might be the same type of thing that happens with the 529 to Roth? Because, I do have we have some people whose children are graduating and there's going to be money left over. And they saw this and want to do it. And we're kind of holding still because we don't really know what the answer is. And, it's not really that the 5 years, but we have had conversations, like you mentioned, they received an academic or athletic scholarship. There's going to be a bunch of money left over. And can they change it to daughter, then other son, then can they just keep going down the line?
There's wealthier families that use these we almost called it a dynasty or legacy 529, where they sort of overfund it. And then over time, they're changing beneficiaries to different lineal descendants, right?
Yep.
That it's sort of like a poor man's education trust, really. Now, it can get a little complicated because, not to bore everybody, but if I change the beneficiary from my son to my daughter, there's no gift issues or anything like that. I've already made a gift initially. But if I change it, if the beneficiary changes from my daughter to her daughter, now we're going a younger generation, And then you just have to be aware that technically that would be a gift to the next generation. But these legacy 529 plans that people set up, they're aware of that gifting. That's part of the planning. And what they're trying to do is get so much money into 529 that they're taking care of the education needs for their descendants going forward, at least for a while anyways. There's no law of perpetuity with 529s that says the government says, okay, after 90 years, you're going to have to take the money out. That could change, but there's nothing that exists today on something like that. And then
Okay.
obviously you have the option to do the 529 to the Roth as well.
Okay.
Yeah.
I don't see any, I could go all day, but I don't want to bore everyone because this is stuff that I like to, they might need help falling asleep and they can learn about this stuff. I
Me
enjoy it.
too. I'm
But,
guilty. I'm a
but I
tax
will-
geek at heart.
Yep, we will, nobody's raised their hand, so we'll wrap it up. I thank everyone. We're gonna, hopefully that what happened when it stopped recording, I'm not sure how that happened, but we will, clean everything up and probably get it out to everybody. So I really appreciate everyone joining us. We will, as I just did it again, I guess maybe my mouse was sitting in the wrong spot. We will end things here, and Mara, good seeing you. Thank you, everyone. And if you have questions, like I said, let us know. We will get that all answered for you, and we can get everything to you guys. So thank you very much. Bill, appreciate it. Mara, appreciate it. And thank you, Franklin
It was a
Templeton.
pleasure.
Thanks,
Thank
guys.
you. Yeah.
Bye-bye.